Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to the 52nd episode of the Capital Mind podcast. In today's episode, Deepak takes a closer look at the crypto crash and discusses its possible impacts on the broader market. We discuss the wealth effect, how even investors with little to no crypto exposure are still impacted, the effects of the crash on what we might think are boring non-crypto companies, disturbing personal anecdotes from our customers across India, parallels between some of the recent crypto bankruptcies and Indian mutual funds, and finally, a silver lining including how crypto might have changed markets overall for the better. Whether your portfolio has crypto or not, do listen in to get some insights from Deepak regarding surviving bear markets, identifying scams, and just understanding risk. Deepak, if you're a person who hasn't really participated much in crypto, and now you're watching these all these various coins fall in price and this bear market or crash happen, isn't this actually, let's say for people, stock market investors and others, isn't this in a sense almost a blessing in disguise? You can't invest in crypto easily anymore, so that money should get funneled into the stock market. If you haven't been investing so far, then you haven't fallen as much, comparatively almost not at all. So I guess what I'm asking you is, this crypto bear market, does it have an impact on, say, the wider economy? Or is this just limited to the folks who are unlucky or unfortunate enough to get into crypto and are now seeing a lot of their net worth get wiped out?
That's a brilliant question, Shray. In fact, here's where the problem is today. It's not really that money is the constant thing that we all have. And therefore, if we can't invest it in crypto, we'll invest it in stocks. Perhaps some of that might happen over time, but the issue is something else and something deeper. And I think it's behavioral. It's the wealth effect. The idea that a person invests only in one asset is no longer true. People invest in multiple asset classes, and you have some equity, you have some debt. And because of the moves in crypto in the last few years, people have had some money in crypto as well. Now, there is a reason why housing prices going down affects everything else. And one of the reasons is simple. If I buy a house and its price goes up because somebody in the neighborhood sold a house for a higher price, I immediately start feeling rich, even though I have no reason to, because I'm not selling the house right now. And even if I sold the house, I'd have to buy another house for roughly the same price. The rationality does not matter. The irrational thought process is, I just got a little bit richer. So in America, you had a problem when housing prices started to go down. Early in the early 90s, they discovered that this wealth effect has political ramifications as well, because people feel that they own their own houses, that they politically participate in the local economy and all that stuff. But also that the wealth effect, if housing prices went down, that a lot of more people got affected, because when people start feeling poorer, they spend a little bit lesser. And especially when you are in a housing situation where your returns are much higher because of leverage. So if you buy a house for 1 crore with only about 10 lakhs down, the rest is a loan, or 20 lakhs down, the rest is a loan, and somebody sells a house in your neighborhood for 1.1 crores, it's only a 10% increase for them. But what you're thinking is, listen, if I sell my house for 1.1 crores, I have an 80 lakh rupee loan. I am left with 30. I invested 20. I have 30. It's a 50% appreciation for me. So that's the knockdown effect of leverage. What happens on the other direction is even worse. What if that 1 crore house goes down to 90 lakhs? It doesn't make a difference to you because you can pay the loan, you can afford it. But over time, you start feeling like, listen, I have lost 50% of my down payment. At some point, it irks you that, boss, if I sell this house, I still have an 80 lakh rupee loan, but I'll get only 10 lakhs back and I invested 20. I have lost a significantly higher sum of money. This feeling of losing money is counter to the feeling of gaining money when the asset price goes up, which is when the asset price goes up, you feel a little bit richer. What people used to do was, in the US at least, you had the ability to refinance your loan at the higher valuation. So you value your house for higher, you get a higher loan. Now, what happens when you get the higher loan is that extra money that you're not used to buy the house can be used for other things. So they called it a home equity line of credit. You could use that money. So you could technically take the appreciation on the upside and use it by taking a line of credit against it and use it to buy TVs and stuff like that. This only went sour because housing prices started to come down, and people who didn't deserve to get these kind of loans in the first place because they didn't have the incomes to support it were the ones getting the loans, and then they defaulted and all that stuff happened. But in general, this is the way the system works. Now, if you take a housing price and bring it down, people lose that potential extra wealth thing, and then they start feeling poorer as well. This feeling of poorer has a knockdown effect. What happens on the other side? When people feel rich, they invest in more things, they consume more things. So effectively, that stuff is gone when the price starts coming down. So if you've invested a little bit in crypto and you see it go down 50%, you feel a little bit poorer. This may not necessarily be a huge part of your net worth, for instance. But the fact is, when you invested in crypto, you probably thought of it as, this thing is going to change my future. Even if I put like $100 in it, or 1,000 rupees or 10,000 rupees in it, it is going to give me a significantly higher return. But when it falls, there is some part of you that says, you know what, I don't want to invest in anything, because that don't invest in anything, don't consume, creates this funda that you don't even do it for other asset classes. That means when one asset class goes down, it has a knockdown effect on hitting other asset classes as well, simply because, and it's not like everything else is holding up. Every other asset class is also falling. It's just falling a lot less than crypto. So now you feel poorer just by the nature of the fact that it's a globalish kind of world. And you know what, this time, compared to earlier, when bonds would go down, stocks would go up. Now, stocks went up and bonds went up at the same time. Stocks are going down and bonds are going down at exactly the same time. And so is crypto. So when they start noticing that everything is correlated, at least on the downside, you invest in nothing at all. And that causes people to say that, listen, I don't care if my crypto is going down. So if I was only crypto investor, so I suddenly switch and become a stock and market investor? The answer is no. Even though stocks are real, stocks are probably attractive, they're great valuations to buy it for a lot of companies. And yet, you kind of look at this and say, no, I don't want to touch anything because, I've lost 50% in crypto. I have become a reformed person. I want a fixed deposit. There is also a real world downstream impact, because your business itself may get impacted by a different mechanism. I'll give you an example. For instance, if you're in the financial services industry, or if you're in the IT industry, providing software to financial service companies, let's say all over the world, one of your customers is a hedge fund that is invested in a lot of asset classes, one of which is crypto. The hedge fund requires you to perhaps recalculate their NAV all the time and all that stuff, and you're doing this work in India. But this particular fund is invested in crypto and made fairly big losses in crypto. Because of that, its customers are coming in and saying, listen, give our money back. The hedge fund is losing money, which means it's also losing its management fees on that money that it's supposed to have. At some point, the hedge fund pretty much decides that enough is enough, and they don't want to give you the project contract anymore because A, they can't afford you, or B, they don't need you because the operation isn't quite as big anymore. You lose money or a contract even though you have no direct exposure to crypto in the first place. You might not even have cared about the asset class, and suddenly it's come and hit you in the face. So there are indirect knockdown effects of what crypto can do to you in the real world, and almost none of this corresponds to the common view that if somebody is losing money in X, they're going to take that money out and put it in Y. What I'm saying is they'll probably take the money out from X and take the money out from Y as well and kind of say, listen, it's time for me to just invest in a fixed deposit. Let me just not do anything at all.
Which sounds like that's the recipe for how you get a recession, right? I mean, in the US. And I think just expanding on that second point you made, if you could go deeper into it, it's not just that your client is, say, someone exposed to crypto. The fact of the matter is that crypto had a real world footprint as well, to a large extent, and that will get impacted. So maybe if you could talk a bit more about that. I mean, what do you see happening in the real world, which is very clearly a slowdown because of the crypto fall?
No, this is a very interesting point. I think so much money and thought process had gone into the crypto world saying a few things. Look, crypto, there's only so much Bitcoin in the world. There has always been only so much Bitcoin. And the amount of new Bitcoin being minted, which reaches eventually that limit, is limited by time, not by processing power and all that stuff. So over a period of time, we're going to have only so much Bitcoin. Yet the price of Bitcoin falls 50%. This, I think, is a breakage of the thought process. That's something that is getting scarce or is relatively scarce compared to US dollars. Should always appreciate. To lose 50% is an anomaly, even in dollar terms, and should have been an anomaly once you got, at the early phases of a cryptocurrency, you might say, oh, there's a lot of volatility because it's new, people don't understand it, and all that stuff. Now, you don't have that excuse. Everybody understands what crypto is, at least what Bitcoin is, and therefore, it should not be going down quite as that much. So why is it doing it? And what happens when you win this? So the real world connection was, first, to mine crypto itself, for instance, you needed GPUs and processors and all that stuff. And some of the biggest manufacturers of GPUs or graphic processing units, manufactured sometimes even special chips for crypto processing and things like that. Yet those companies, once the crypto bust has happened, their stock prices have fallen 50%. So the real guys, they must have set up a lot of more supply as well, saying this supply is endless. I'm going to need more and more and more chips. I manufacture more chips, and suddenly you find out the crypto world has kind of, the carpet has been pulled out from under you, and you suddenly are with a glut of high processing power chips. Now we think of this as, why not? We can use it. Remember, your car, which uses a chip that's the equivalent of something that was maybe 15 years ago in the computer processing world. The GPUs that NVIDIA and all created are probably, state of the art. So it will probably take another 5 or 10 years before cars will want to use something of that processing power. And who wants to play a game, in this thing of your car? So you're not, the only thing that might happen is if there is a shortage of chips that cars want, they might be able to use these kind of chips to substitute for the same. I could use a Mercedes car to get groceries from my next door shop. It would be a gross underuse of a high powered car or a fancy car. But you know what? If you get the Mercedes for the price of, a scooter, then why not? So maybe if there is a knock-on effect there where it's just positive, which is that although these chip companies have been battered by having to create capacity for crypto and then crypto falling out in the first place, that there is possibly a positive link to it also. But I do think that the negative is much more. It's like somebody created, when onion prices go to 10 rupees, it's not because people have now stopped eating onions. It's because you produce way too many onions and there are not that many people in the whole world in the first place. So you produce more onions one year, and then there's a glut and the prices come down, and the onion farmers undoubtedly lose money because when they started to plant those onions, the prices of onions were 50 rupees a kilo. Now it's less than 10. So the glut always results in a subsequent year in an undersupply, which means the next year we're going to be short onions because people are not going to make, plant onions anymore. In the real world, I think the problem then becomes the same companies, the NVIDIAs of the world, will not invest in building a lot more capacity anymore because they've built whatever they have. They've burned their fingers. They might want to nurse their wounds and lay low and sell what people want for a while while not getting really innovative on that, or not innovative, but I would just say not produce a lot more, not invest in a lot more capacity at this point. This does result in potentially lower investment as well, and nobody else wants to enter this field to compete with them. So that's the second part. So for instance, you had Ethereum, and Ethereum has a coding language and stuff like that. So people learned that language, they built, they said, okay, we'll build a coin on top of the Ethereum framework, which could kind of interact with the Ethereum blockchain. When they did that, they raised money, they set up a startup of their own, they, hired employees. There is a definite linkage here to the real world, because once you create a startup that does something like this, you're no longer dealing in crypto, you're dealing in real money currencies, you're dealing in real money rents to commercial space, real money advertising dollars to Google, because Google didn't take crypto. Everybody else in this ecosystem, including the chai wala that perhaps gave chai into those startups, was benefiting from this. But if these startups are now to not be funded or to have lost their funding mojo, I think that has a clear, disadvantage in this whole process. So if they fire people or they spend less, that much less money starts trickling down into the real economy further as well. So I think that is another part where you have a real world linkage to a problem which was supposed to stay in the crypto world.
One thing which comes to mind to me is, I guess this is sort of blurring the lines, but there are people who invested in, say, crypto banks or crypto assets or crypto securities, not really thinking that they were taking on any cryptocurrency risk, but perhaps lured in by what they thought was just like a higher rate of interest. I mean, if I may almost say, it almost felt like it was a fixed deposit, a US dollar denominated fixed deposit giving you 12 or 13% or something as high as that. So there were people who had this exposure, and I think they didn't think they were taking on crypto risk, but that could be a problem now, right?
Yes, in fact, so this is interesting because one of the crypto startups that did exactly this, called Wald, went bust. And the issue with Wald was not that it was a crypto startup, but that it actually told people that it was not a crypto-based asset, in the sense that they said, listen, we've got this stable coin of some sort. That stable coin is linked 1:1 to the dollar. So if you invest in that stable coin, it's like investing in the dollar. So 1:1. Then you could pledge that crypto, which is 1:1 linked to the dollar. So it's not crypto, it's actually a dollar, and get 14% returns on it. Now, the first few people that got 14% returns then magnified their returns and said, okay, great, we've got this. A bunch of influencers got involved and all that stuff. The issue then was that how come this startup failed if it was not the high return on capital, it was the lack of return off capital, because what they had done with the crypto in an asset class which has only 21 million Bitcoin, how do you get more return on it, right? So nobody's printing more Bitcoin. So Walt promised that if you give me Bitcoin, I'll give you 14% on Bitcoin. If you give me USD dollars linked stable coins, I'll give you 14% return in that stable coin. So it was like a phenomenal deal, except nobody's thought to say, how are you making this 14% when everything else that is safe is making only 2 or 3% in USD terms? The problem was they were giving this money to hedge funds and sort of crypto yield farming, other kind of startups, some of which failed. And when they failed, they didn't give back the money, the principal that they owed in the first place, forget the interest. So now Walt is sitting there saying, listen, forget your 14%. I don't even have the $100 you gave me, even if it was in stablecoin, because that stablecoin may be linked to the dollar, but I don't have the stablecoin. I've given it to somebody else to go and farm and get results for me that I could then take and give to you. This was unheard of, because you suddenly said, it was a great return, but now there's nothing. Not even forget on capital. There's no off capital, return off capital either. So that means I'm losing all my money and all the potential interest I should have been making in the first place. Everything's gone overnight. You've actually taken a guy who said, wait, I thought this was not crypto and I was still getting 14% returns on my money, to I am getting nothing. This was crypto. Nobody told me this was crypto. I wouldn't have gotten in otherwise. That, I think, is another big impact over here, because these people who were sold this didn't necessarily want to bet on the crypto world. They just wanted high returns on their money. They weren't looking at this as a highly speculative asset. They were being sold this as an equivalent of a fixed deposit. And you don't sell a fixed deposit to someone who's looking to make it go to the moon. You actually are looking at downstream issues when people are missold something, and people have been missold this. Unfortunately, it's happened. It's happened right in front of us. And some of the crypto arguments against us are like, listen, we've got over collateralization. So stable coins. Why did the Luna Terra kind of stable coin go down? Because it wasn't, you could pay $1 to buy a Terra or a Luna. I don't know which one it is that's supposed to be the stable coin. And they would print Luna to kind of, balance it out. You'd get something. The issue was that there was no dollar supporting it actually. So what would happen is when the price of Terra went below a certain level, this algorithm that was synthetically managing this would buy Luna to balance out the Luna and Terra ecosystem, so that Terra price would come back up. And if it went too far up, it would sell and then it would bring it down. So it was essentially a mechanism that would balance this by just selling one fancy virtual asset called Luna for another fancy virtual asset called Terra, so that the Terra price could be pegged to $1 per Terra. So, or, roughly that. The problem is that peg broke because of a lot of technological issues and timing and fraud and perhaps just plain old, speculative vultures getting at it. Whatever excuse that is, that the fact is that if I gave a Terra, I would not get $1 back. In the end, it kind of surfaced on that. Now, what some of the other guys are saying is, oh no, you know what? If you've given me $1, I've taken your dollar and I've given you one USD tether, USDT. I have $1 against it. And I am fully collateralized. In fact, I'm over collateralized. Now, how are you over collateralized? You say, you know what? I've invested in something. And the something's market value, if I sold it today, is not $1, it is $1.2. So therefore, I'm 20% over collateralized. To anybody born yesterday, this sounds like a great idea, except if you've seen this before, this sounds dumb because any concept of over collateralization has issues. And I'll tell you how one of the biggest examples. If you use it as an asset or a crypto as an asset or a payment, I'll give you, like, for instance, MicroStrategy. It's a company in the US run by Michael Saylor. They've borrowed billions of dollars, I think billions or some very large amount of money to invest in crypto. So they only invest in crypto. They don't do anything else. He owns a truckload of Bitcoins. And what he has done with those Bitcoins is he's just bought them and kept them. Now he's taken a loan. This loan may only be, for instance, they say that MicroStrategy is over collateralized because they have borrowed maybe $1 billion and they have Bitcoin worth $10 billion or $5 billion or some number like that. Again, this account to me is like crazy because when Bitcoin falls 50%, MicroStrategy has to announce losses of that 50%. And of course, it will affect its share price and all that. But also, it is the collateral behind the loan it has taken. Now, it may have taken the loans at much lower levels. Now, they already said, listen, at $21,000, the loan goes underwater. So whatever collateral he had pledged against that loan itself, he has to put more collateral down. Now, luckily, he's over collateralized, so he can put more collateral down. But a bank might tell him now that, listen, if you gave me 1.2 for every $1, 1.2 worth of Bitcoin for every $1, going forward, because Bitcoin is so volatile, you'll have to give me $2 worth of Bitcoin for every $1 you've borrowed from me already. So he may have to top up with a lot more collateral than he has. And the price now is 19,500 or so. If it falls to even 10,000, the banks are going to be like, listen, we are going to sell this Bitcoin. Now, why do they do that? Because you know what? At about $3,000 or $4,000, even all of MicroStrategy's Bitcoins put together, that means they had much more Bitcoin earlier, right? All of that Bitcoin put together cannot pay for the loan. So, but will they wait till 3,000? Because if you sell when it's 3,000, it'll go to 1,500. So they will start looking at selling when it's 10 or 11,000. But I mean, this sounds crazy, but let me tell you how it happened in India. And India's mutual fund industry has probably learned a lesson from this. Okay. So you've got Dish TV, you've got Zee. Now, Zee is one of India's largest, most profitable media companies. It's a fantastic company from a perspective of saying, listen, this is a profitable, wide mass reaching media enterprise created by Subhash Chandra. Subhash Chandra, unfortunately, had other companies also owned by him privately. He also owns the publicly listed Dish and Zee TV. And he owned a reasonable percentage, 35-40% or something like that of these companies. And then he said, now my ownership in those companies are on certain shares. I'm going to take those shares and use them as collateral against loans. Now he, instead of taking loans from banks, he took loans from mutual funds, because against collateral of shares, banks cannot lend more than 20 lakhs or something like that. So they said, listen, these NBFCs or mutual funds can actually give me loans. They can buy bonds. A lot of bonds were bought. I think 1,000 crores plus worth of bonds were bought by mutual funds against the collateral of Zee shares. Now, Zee was in the Nifty. So it's not like it's a small company. It's not like it's a small share. Its price was, say, 500 rupees or something like that. So at 500 rupees, if you give 1,000 shares, that's 5 lakh rupees worth of collateral. What mutual funds did was said, listen, I'll give you 4.5 lakh loans or 4.1 lakh rupees of a loan against this, because we want only 20% over collateralization. Unfortunately, Subhash Chandra took the money. It was taken in the name of a bunch of infrastructure companies that were doing really badly. They were struggling for things. Not their bad assets, but they were just, some of it was bad timing, some of it was bad performance, a lot of other things that worked out or didn't work out at the time. And what happened then was that he couldn't pay back. Now, when the companies can't pay back their loan, the first thing that you might think is, listen, if you can't pay it back, I have the collateral, I'll sell it. Subhash Chandra said, don't sell it. But a couple of mutual funds said, forget it. We want to sell it. And they sold the shares. Now, this is a nifty 400 crores worth of shares. I'm not talking of a huge amount.
Zee shares.
Zee shares. Zee is a nifty and one of the larger companies in India, and then proceeded to fall 40% on that day. I think that day or the day and the next day. So that's a nifty stock falling 40%. And you're thinking, my God, now what happens to a 120% collateralized system when the stock falls 40%? If you've got 120 rupees worth of a stock and it just falls 40%, now you have 72 rupees worth of a stock, but you've still lent 100 rupees against it. You simply can't deal with this. But you also know heart to heart that if the next day you go and sell, that 72 rupees can become 35 rupees. You will just, in the end, just lose money. And Subhash Chandra pretty much told the mutual fund people that you can't sell any more shares. If you sell any more shares, I'm not going to give you any money. You please recover from the shares itself, because these infrastructure companies are dead or they're not going to pay back. So what do you do? So he said, listen, I'll make a plan. I will sell my Zee shares in the market to someone at a better price. And when I sell them at a better price, you will get your money back. Unfortunately, a lot of things happened. He had to renege on some part of this deal. SEBI also got involved. SEBI said, why are you guys making deals with people? Why don't you just sell the shares? I don't care what you get. You might as well recover whatever you can and then go to the court for the rest. Fair ask, but I think the mutual funds were like stuck between a rock and a hard place. Some of them decided to go with, had already decided to go with Subhash Chandra, and he eventually did. So the issue here was everybody thought the loans were over-collateralized, except it was only 20% over-collateralized. To the point now where SEBI has said, listen, unless they're 2x over-collateralized, don't bother.
Well, if that was in crypto, then even that wouldn't have been enough, right?
Yeah, well, yeah, that's my point. If a Zee share, which is a nifty level share, could not deal with 20% over collateralization, and perhaps the only thing that would have worked for that company is 100% over collateralization, then why would crypto do anything less than, say, 500%? It makes no sense at all because Luna and Terra, the way they first fell 90%, 96%, and I have a tweet on this. They fell 96%. And the subsequent 15 days, they fell another 96%. So it sounds like, okay, mathematically this is impossible, but it's not, because if you fall from 100 to 1 rupee and from 1 rupee to 5 paisa, you've actually done 99% plus 95%. So it is insane that you could see a fall of this magnitude in what was supposed to be a VC backed, community led, crypto fancy stable coin protocol. I I mean, the fact is, it defies logic, but it's there. So once it's there, you can't deny that it does. I mean, so the problem is that we have taken those assumptions. I'll give you one of the biggest assumptions that brought down the world in the subprime crisis. Was one of the factors was that there was a risk management algorithm, and that risk management algorithm would calculate the amount of capital a bank needs in order to handle all the housing loans that it had given. It had a lower range and the upper range of the prices that housing prices could fluctuate by. Unfortunately, the lower range and the upper range values were limited to only positive numbers, because the software writer and whoever the project manager was didn't even foresee that prices could actually be negative. Who lose money in houses? Come on, that's insane. But yes, that's happened, and 40% down happened. And you know what? I think the same things happen in the crypto world. People have been thinking, how much can it fall? It can't fall more than 50%. Well, it fell 95, 96, and then it fell another 95. That is just downright insane. So if we haven't seen the volatility of something like this, and if you don't do it, then you see impacts on the real economy. So because somebody real might have MicroStrategy has taken a 10x loan, that means he is 900x or 9x over collateralized. I still think that's not enough. Because when things start to fall, there will be nothing to stand in the way. They will just sell and sell. And because what would result in that fall, what would trigger that fall would have been something like a regulation. And that regulation can be so onerous that anyone holding crypto, like in India, you have 1% TDS. It makes no sense for an exchange to run anymore. The volumes are there, but they're very thin and they're going to die. So anybody who was running a crypto exchange in India is finished. So they have to go outside India. They still have avenues. But if the world got together and said this is a bad thing, the next day, the Bitcoin is falling 95% on that day. What happens then? You don't have assets. And then whoever has lent MicroStrategy its loans is now thinking, I thought we were 9x over collateralized. So what's the problem with that? My thing is, it doesn't matter what it is. If your loan is dependent on one collateral and that collateral is volatile, almost nothing will be enough. And when you want to sell, everybody and his uncle will want to sell. Exactly at the same time, you therefore are sitting on a potential fire sale of gargantuan magnitudes on an asset which has no intrinsic value more than you like it, I like it, therefore we see value in it. This is the same thing with gold. There is no intrinsic value to gold, but it's just the fact that you've valued it more and I valued it more, which is why if all of us get together and decide that gold has no value, then gold has no value. Unlike, for instance, copper, where we can decide there's value because I can make copper wire out of it. The amount of industrial uses of gold is so tiny compared to the overall supply of gold, is that if that were the only thing left, gold price would be like $20 troy ounce. But it isn't. It's $2,000 just because of the perception thing. Bitcoin is all a game of perception. If your asset is a game of perception, it's not an asset. At most points, you should treat it like a liability, because now you have given out a loan against something whose intrinsic value is only what you and I perceive it to be. And it's not even backed by guns like the US currency is.
Interesting point. I was thinking, as you're saying, there's two extremes of people I'd just like to bring up who also might be impacted by this. So one was, some of our customers had mentioned to us that when they sort of got around to smaller towns or maybe even rural areas, they were like crypto influencers or local experts who had gone around telling people how this was the next best thing. And there were certainly ads in the newspapers where these crypto, maybe it was the exchanges or all the companies in together, had said, we have more reach than the stock markets or something like that. And they were trying to use that as a way of saying you should have more favorable regulation. So I'm guessing life hasn't gone very well for people who made their first risky investment in crypto and and perhaps even borrowed money or used family funds to do it. And the other one, which you had mentioned, was at the very other end of the food chain, which is, say, VC firms, which has invested in these. In theory, they should face some pretty severe losses now, and that would probably have some impact on them. Although, when I look at the press releases, they still seem to be raising big funds, so not sure. Do you have any comments on these two ends of the spectrum?
Yeah, very interesting point on the first thing. I think so. That was probably a COVID thing as well. So what happened in COVID was that people from the cities went to smaller towns, to the villages. They were knowledgeable enough about phones and transacting through phones, and then the bunch of these crypto startups came up and said, "Listen, you know what? No KYC. Just come here and give us your money, and then you can invest in these things." They trade 24 hours a day. There's no regulatory oversight to anything. So prices can go up 60-70% in a single hour if they have to. People look at this and say, my God, this I could have made 60x my money just standing here. When you're in the middle of a COVID crisis, there are no jobs. You're not even allowed to go out. Well, in the rural sector, it didn't matter so much. But there aren't enough opportunities in many of these places to do anything of that size where you can get 50x your money. And then there's this city bloke who's coming and telling you, yaar, ye phone hai, see this fancy actor ka ad hai. He's telling you ki bas dalna, everything is fine and all that stuff. So you should believe the film actor. You should believe me, I'm a city bloke. And they've gotten into it in a way that perhaps was unimaginable earlier. They put small amounts, put 10 rupees, 100 rupees, 50 rupees, which you wouldn't see a person investing in stocks or even in mutual funds, because mutual funds, there's a friction of KYC and this and that and all that stuff. Here, there's nothing. Just get in, start trading, and every second, even through weekends, your money is investable, tradable, and all that stuff. I think that this crypto shock that has happened has probably wiped out the living daylights out of a lot of people in the rural sector and the tier 3 town sector, and perhaps created a feeling that all of these people who on the internet or on TV tell you to invest in certain things are all frauds. It's natural because they've invested in something, they probably put life savings in something like this. They've watched it go around, and then so I think here is where there's a social and economic crisis. Now, social crisis because when people lose money like this, they often get violent. And in a setup like a city, you may have varying views. You may have a police force and so on. In smaller towns, there is hardly any of that kind of thought process. And if people lose enough money, they could socially outcast somebody, for instance. That has serious economic implications because that person will not be able to. So, other person's family may find it troublesome. People might say, it's your responsibility to pay me back the money that I've lost because you were the one who suggested it. That creates a bigger social impact because then the stigma of that person and the person's family and so on, because this is much more prevalent in rural setups. You can't escape. You're there, you own land, you've been farming there for like forever. You can't just run away and say, I didn't do it. Second, when people lose their money and their hard-earned savings, the rural economy is anyway so tiny, it kind of subsistence level stuff. It creates an economic crisis for them. Some of it may be their own making. So, for instance, someone who's young, who's just taken his parents' savings and put it into crypto, watched it go up and gotten proud that he's grown his family's money, and then watches it go down to close to zero. That person's not going to get an unforgiving thought from anybody else. But also the fact is now there's an economic crisis because they don't have any money. So what do you do now? I think this is a problem. This is a real world problem that we're going to have to solve. And perhaps it's happening right now. It's just simmering under the surface, and it will manifest itself in very different ways when it eventually comes out. On the other end of the spectrum, which is the venture capital going to crypto, I think the wealth effect also affects the VCs. Now, VCs in general, VCs are no longer single entities, right? So in the sense, people who invest in early stage startups to mid stage to late stage. Now, a lot of PE funds start to get in. SoftBank, for instance, or Tiger. Tiger is a hedge fund which invests in everything. Public markets, private markets, startups, equities, everything. If they had direct exposure to crypto, they would have lost money. If they have invested in crypto level startups, the startups are in trouble and perhaps they will lose money. The wealth effect of seeing that happen hits them themselves, where they might say, listen, hunker down, don't invest, because we just lost a truckload of money, even though it's a small portion of the portfolio. Their LPs themselves may be a little scared, saying, weren't you guys too much into crypto? And most of the VC world works on what is called commitments, which is that you don't actually get the money. You have to take a start. You have to say, listen, I've found 3 startups and I'm supposed to invest in 20. So can you please give me 15% of the money that you've promised to give me, which is in contract. So you have to give me the money when I ask you. And, you kind of take the money at that time and go and do it. Now, this sounds like, tomorrow if they find new startups, they can just go back to the LPs and say, give me the whatever commitment. But you see, this is a very relationship-based world. If the LP is feeling antsy about your crypto investments, no matter what contract you've written, they might say, listen, don't do a drawdown right now. You guys have lost money already, and we would not like to push this any further. If they do this, they will not be able to go back. They may have a startup to invest in, but they might be feeling, you know what? I don't think I can take this to my LPs anymore. They're already pissed with me. And if I take a drawdown now forcefully, they will find a legal way to kind of avoid, or they won't invest my next fund, but they won't commit money to my next fund. So you don't go at all. So it becomes a relationship-based thing. There's this wealth effect that hits the LP themselves, who may be a fund, a pension fund or something like that, who may be therefore saying, listen, we've just lost money on crypto. It will be 5%. But you know what? My whole promise to my customers was 8% a year. The pension funds required return was 8% a year. If you've taken 5% off that, and that's dropped 50, by half, then I've just lost 2.5% of that little 8% I was supposed to earn. And even stocks are down, other things are down as well. So you know what? I don't want to commit more money to this super risky area called crypto investing, or venture funds that have crypto investments in them and all this stuff. So the problem right now is that crypto companies haven't died. Not many have. There are only maybe 2 or 3. They're just in the early process. In the .com era, VC companies collapse just as much as regular funds collapse. So I remember, I think there was this guy who created a .com hedge fund. A .com hedge fund. This was John Merriweather, one of the guys who was in long-term capital management, Salomon Brothers and all that. He created a .com based hedge fund, and that fund went bust during that time because they invested in public markets in companies that were in part of the .com. I think here VC companies haven't died at all. That's because the downstream companies themselves haven't died at all either. So we've got a problem that is manifesting but has not really manifested down yet. It's still a much, much smaller problem than Lehman. Much, much smaller problem than Lehman was, because Lehman was super leveraged. But I think what this might end up resulting in is that there's going to be lesser venture capital available. I know it sounds stupid to say that just when a bunch of VC funds, especially in India, have gone and raised like $500 million and $1 billion and so on. But I think when this manifests into a point where startups are going down, and probably the cascade effect, because when one crypto thing goes down, they seem to have their tentacles in 10 other crypto things. It takes a while, despite the rise of technology, for those 10 other fellows to come out and say, guys, they are screwed, so we are also screwed, which is what happened. World was screwed because some 3 Arrows Capital was screwed, and 3 Arrows Capital was screwed because something else was screwed, and so on. So this concept of tentacles and then a slow move from one piece to the other is the beginning of the crisis. Eventually, everybody starts saying, listen, if he's dead and he's dead, I'm also dead. So that cascade effect starts to work very, very fast. At that time, venture capital will suddenly become unavailable, regardless of whether you're a great company in whatever space. I mean, because the guys, it's not like venture capital is the most efficient capital allocator on the planet. Venture capital is a herd business, right? So if 5 venture capitalists are investing in something, then the 6th one is also, because everybody's thinking, I need to sell this onwards. So there has to be bigger funds beyond this who will buy into the same companies and increase my valuation. And eventually, this company can go IPO. If there is a certain sector that's hot, everybody's investing in it. So I think here, this concept that there will be no further investor investing in this because it's a dead space, the biggest, at some point, every venture capital company was thinking an exit option is to sell to get SoftBank to invest, because SoftBank would come in, buy all the other VCs out, and be the biggest investor in the last round. SoftBank is no longer there. Once you don't have a SoftBank, you say, okay, well, let's go to public markets. So you go to public markets. Now the public market prices bomb. Nobody else wants to go IPO in the public markets. Suddenly that avenue is also not available. This downstream approach already starting to hit VC companies, but you add a crypto bust into it, where you say, okay, well, companies are going to die even if they're great, VC funded. Whatever. Wald was funded by Peter Thiel, who's, I think, what was he, PayPal?
PayPal.
Yeah, PayPal and Facebook and so on. So even he got this wrong. So what are ordinary other VCs to do? So effectively, I think at least that, we are in a world where one time, if you are a non-crypto startup, you didn't get funding because you were a non-crypto startup. It was not great as a space to be at that time. If you're a non-crypto startup looking for funding at a time when the crypto bust is happening, you're probably not getting funded, not because you're a non-crypto startup, but simply because the wealth effect has hit the VC world. And they're saying, listen, pause on everything at this point. This is a real fear, though it may be a fear only for the rich, because who else gets funded?
Sort of my last question on this is, as you've been describing this, at least on social media, people have been quick to call out, almost with a sense of schadenfreude, that, look, in the crypto space, you're just reinventing all problems that, say, the traditional system has learned how to solve over the last, hundreds of years. You've just had an accelerated learning of those very same problems and will come up with the same solutions, kind of making the whole thing meaningless. So I just wanted to ask if that's also your read of the situation. And then that leads me on to a follow-on of, so is this just about cycles? Like in the real world, there's recessions followed by booms. Is this a very painful bear market, but there's just another bull one? If you can survive, there'll be another one just around the corner.
I think, that's a very important question to answer, because I think if you're a crypto investor or you're a crypto player or a crypto participant, you're thinking of this as a revolutionary new thing, right? So is it the death of all the revolutionary new things that have happened in the world? I think not, because I think while crypto is hurt right now, and it's hurt because of being overly speculative, there are certain good things about it, but it's a greed and fear cycle. It is greed and fear all over again. It's the same problems in code. That's, so if you've taken economics from the longest time and put them into code, you would get crypto. Except you're starting from zero. You're not even learning from the economic problems of the past, like over-collateralization, volatility. Why people did not allow 24-hour trading for most things was also because people got some time to think about. Why people set up circuit limits on stocks was that if you didn't have circuit limits, stocks could get manipulated and extremely volatile, both of which were undesirable. Yet crypto guys never learned from this and said, we want the undesirable because we think that is progress. But it didn't become undesirable for no reason. It was undesirable because it was manipulated. And crypto's biggest problem is manipulation and fraud. Though it's not addressed directly in anything, people keep saying, oh, there's fraud and everything. Of course there is. That's why there are regulations. But crypto has no regulation. So it's the same thing in just a more fancy avatar. Now, it's like, in a way, if you look at buy now, pay later as a concept, someone said this recently, it's like a subprime lending on an app. So there are people who never get loans. So you give them small, tiny loans. But, a small pellet of shit at scale is just a large pile of shit. So it's just, you can't change the fact that somebody who's getting some of these loans is subprime. I was never supposed to get one in the first place. It's the same problem, just created in a different way. Whereas earlier you might say a corporate loan, which was very large, is a big pile of shit. Here it's not very different. It's just so I think Bitcoin is the same thing. It's just greed, fear, conceptually. It's just. I'll give you, for instance, one of the examples of how it is, absolutely spot on in terms of what has happened in the past to how certain things broke down very recently. For instance, if you look at market manipulation, there are certain rules in stock market saying a promoter of a company cannot sell more than X in the market without disclosing it. So they can sell a certain amount, but they have to disclose that they have sold a certain amount. If they buy more than a certain amount, then they have to make an open offer to all other people saying they have, they're willing to buy it at a certain price. Now, why did these regulations ever come into place in the first place? Because things were manipulated. Promoters bought and sold and did a bunch of things and all that stuff. None of this was there in the equivalent of the. So you created a new world called rug pull in the crypto world. It's plain promoter fraud that has happened in the past. We never called it a rug pull, but because you couldn't admit it was the same problem, you called it a rug pull. And that resulted in a world called rugging. Are they rugging it? Are they not? Even in a world as transparent as the crypto, where you're supposed to be able to see every single wallet and how much, when money moves in from it and out from it, you still had rug pulls of gargantuan magnitudes, because there were no rules set up against it and there was no, fraud protection of any meaningful sort, even by the industry. I think this is essentially where, the whole world has kind of forgotten that this is exactly the same problems that we've seen in the past that's coming back. The last bit, I'll talk about this, So there is a problem with the concept of a limited coin. This is basic. So why aren't every currency that the world has invented, why don't they stop printing any more currencies? It's not because they want to create inflation. It's because of a certain need that they have discovered over a period of time. Now, I'll tell you the classic funda is. If you have a town, there's only one bank in that town, and that bank issues the currency, and that there are only 100,000, 100,000 units of that currency, 100,000 rupees, let's call it. And there's a farmer who makes 100 onions. That's all people want. That every onion is going to cost you a rupee. If the farmer does some fertilizer and plants more and all that stuff on the same field and increases the number of onions produced to 150 or 100 and say, I don't know, 100 or 200, he doubles the number of onions. Now, because there's only 100 rupees in the system, he'll have to reduce the price to 0.5 just to be able to satisfy the population, because otherwise half the people will go hungry. So the price of whatever he offers has gone down by 50 paisa. And the same thing applies to the workers he employs. So if he pays them 10 rupees as a salary, he might have to pay them 5 rupees, because he'll say, listen, you need onions. The same number of onions you'll get now in 5 rupees. Why should I pay you more? Plus, you know what? If I paid you the same amount, I will be out of business. My revenue has halved. My expenses also have to go to half. This is undesirable because people don't like to see their incomes come down. You cannot cut wages when costs come down. So what you do is you fire people, and you fire people, they go hungry because now they have no money at all and so on. So this social impact is countered by the fact that the governments of the world and central banks of the world have discovered that, listen, if there is a productivity benefit in the economy, that productivity benefit has to be compensated by printing more money. To a certain extent, more money needs to be printed. If it is not printed at all, then prices and wages come down. So when Bitcoin was going up in dollars, if you measured your salary in Bitcoin terms, you were making less and less Bitcoin every year. However, if you are paid in Bitcoin, if you are paid, say, 1 Bitcoin every month, then of course, what 1 Bitcoin could buy more and more every month. But like I said, if the whole world was paying people in Bitcoin, they would have to pay every month lesser and lesser and lesser, because the world is getting more and more productive. No matter how hard we try, we can't be not productive. So given this, I think this is a basic principle, right, of economics. How could we forget that? And then how could we then go around creating startups that say, I will give you yield, where I am telling you your wages need to come down in Bitcoin terms. You're saying you give me 1 Bitcoin, I'll give you 1.2 Bitcoin back at the end of the year. That is downright stupid. In a limited availability system, you can't have yield. You have negative yield by definition. So I think forgetting that is one of another big crime mistakes over here. And the problem that the real world has already solved, which is if you're an exchange, you should not be the person in possession of the property of the users of that exchange. In India, they've figured it out. They said NSDL and CDSL are our depositories. They are the ones who hold the shares and the records of the shares that people own. The exchanges are just platforms in which these shares are traded, but the depositories are where the shares are. So the idea being that you do not give when you buy shares, they don't sit with the exchange. Here in crypto world, people had no problem with that. They bought and sold coins. The coins remained at the exchange. The exchange could do whatever they wanted. So the exchanges would then lend out that to crypto startups like Three Arrows Capital or hedge funds like that who promise them great yields. Crypto startup goes bust. Exchange user still doesn't know that their exchange has lost their Bitcoin. They're still trading in that vicinity of the exchange. They don't yet get to know. And the crypto startup, the exchange itself is saying, listen, if we don't tell them, maybe they won't know and they won't withdraw and we'll be fine until a lot of people withdraw, in which time the crypto exchange shuts up and says, well, we won't allow any withdrawals anymore. This is very common in crypto startups, especially when Bitcoin prices go down, is that they disallow withdrawals. I think these are just real world problems we have seen. But why have we not solved them in the crypto world now? I think it's a bit of hubris because, tech people are all, and I'm a tech person, so I always think, I'm smarter than somebody else. But that somebody else might just have gone through the pain and therefore created the laws that sound restrictive to us. So I say, at least, I think the loss of crypto, unfortunate as it may be, is not only going to be the loss of crypto, it's going to be the loss of the whole world, simply because everything seems to have its tentacles and fingers in everything else.
Depressing, but I'll try and end on maybe a positive note. I know you've not really done anything in crypto so far. So, but when this bear market is over and the green shoots once again and the world is optimistic and Bitcoin prices start hovering, have you sworn off cryptocurrencies in general forever? Or do you think that there's one day where you could see yourself getting interested in these?
Well, I think the uses of a blockchain are many, and therefore we could use something like that. So, for instance, I think we could use a blockchain for a low frequency transaction thing like real estate sales. I want to establish the authenticity of the transaction. I want to be able to go to a Bitcoin and see whoever held this. I buy a car. I need to know how many times the ownership has changed hands. We could have a public blockchain for this because people don't sell cars every other day. They sell cars once in 3 or 4 years, right? So it's low frequency in transactions. I see the uses of blockchain there. I see the uses of blockchain in a trade facilitation portal. If a company, for instance, takes a loan from a bank, it has to anyway put this out in public in a certain format on the MCA. Ministry of Corporate Affairs. Why is it not on a public blockchain where instead of me having to go to MCA, pay 100 rupees to see which charges are on which asset, you should have a single asset registry which is on a blockchain. You may have to still pay a fee to access it, but it should be in an easily consumable non-PDF format that is therefore trackable by a program. And I can quickly tell you that, listen, you're not getting this loan because you have loans from too many banks. I think those things will remain. You might wonder, okay, who's going to pay for all of this? Well, there has to be fees in the real world for this. The concept of Bitcoin is sound in the sense that it has a certain limited, so it's a great asset to own and assets by nature are speculative. So I think that part of it, if you were to look at it as a non-speculative, it's like gold, So I think owning Bitcoin like you own gold, and I don't like to own gold, so I am probably not going to buy Bitcoin itself, but that is probably still okay. Now, here's a positive thing. I think crypto has opened our eyes out to 24-hour markets. And we should definitely go beyond the 8 or 5, 6 hour markets we have. And they've taught us that you can settle things, and we should be able to build better settlement mechanisms now, even for high frequency trading systems in relative real time. So, for instance, today, if I buy a share, I get that share 2 days later. Now, we've had conversations with brokers about this. The minute I say less than 2 days, they're like, guys, we're already stretched to the limit with 1 T+2. And T plus 1. So you're saying T plus 0, that means instantly settled. But I see no reason why it cannot be instantly settled, because there's a depository. When you sell a share, the depository can instantly transfer from one account to the other. It's all digital. Crypto's kind of shown the way that this can be done, and we should explore that. They've created the concept of instant loans. So a person should be able to pledge an asset that they own, a security that they own, on a blockchain, which is verifiable, and then get a loan against it. They created this electronically, they could get it. I think we should do something like that in the real world as well, because people have real assets which are digitally verifiable, digitally marked over. Even if you give me a mutual fund which invests in debt and give me a 2x, 50% leverage on it, which means if I give you 100 rupees worth of a debt fund, I should get 50 rupees off of it. That's something crypto has shown the way for, and I think we should do that. But I don't think you should do it in the crypto world. I think it's better done in the real world. And I think we should learn lessons from the fact that a lot of these things which they created are not new. Some of them are, and some of them are useful to us, the concept and all that stuff. But the speculative part of it is actually, it's the bane, not the boon. And if we eliminate that, of course, if you eliminate that, half of crypto is no longer exciting. But if you eliminate that, I think there's a lot of value in what the crypto world has shown that the world can do.
So long-term bullish, but maybe not about the currencies themselves.
That's a good way to put it.
So on that note, let's call it today. And thanks so much, Deepak.
Thanks so much, Ray. It was good fun. Thanks for listening.
Well, that's our episode. Thanks so much for listening. If you like how Deepak and the Capital Mind team analyze markets and think about investing, do try the coupon code CMPodcast for a 15% discount on a Capital Mind Premium membership. You'll get access to analysis, an enthusiastic community of like-minded people on the Capital Mind Slack, and portfolios and strategies to invest your money. You can see more of our episodes at capitalmind.in/podcast. And while you're on our site, you can also check out our fully managed portfolio management service at capitalmind.in. Deepak has a book out called Money Wise. It's available on Amazon, Flipkart, bookshops, or at shop.capitalmind.in if you want a personalized copy. If you have any feedback, suggestions, or topics for our next episode, please send over an email to podcast@capitalmind.in.